Let me ask you something. When was the last time you voted on interest rates? Never. Right? You've never been asked. Nobody knocked on your door. There was no ballot, no referendum, no choice. But somewhere, in a building in Washington, D.C., behind closed doors around a conference table, 12 people met. They talked, they debated, and then they voted. And that vote, that single decision made by 12 unelected human beings, rippled outward across the entire United States economy. It touched mortgage payments in Texas. It touched job listings in Ohio. It touched startup funding in California. It touched whether a factory in Michigan stayed open or shut down. 12 people. One vote. Hundreds of millions of lives affected. And here's the part that should make you stop and think. This isn't a conspiracy. This isn't a shadowy backroom deal. This is all completely official, completely legal, and almost completely invisible to the average person. Today, we're pulling back the curtain on the Federal Open Market Committee, the FOMC, and we're going to understand exactly who these 12 people are, what power they actually hold, how they decide to use it, and why their decisions almost always hurt the people at the bottom first. Stay with me, because by the end of this video, the way you see the economy will never be the same. Before we talk about the 12 people, we need to talk about the institution behind them, the Federal Reserve. The Fed, most people have heard of it. Very few people actually understand what it is. Here's the simple version. The Federal Reserve is America's central bank. It was created in 1913, not by some organic economic process, but by an act of Congress signed into law after a series of financial panics nearly destroyed the American economy in the late 1800s and early 1900s. Banks kept collapsing. People kept losing everything. And eventually, the government decided America needed a lender of last resort, a financial backstop, a referee for the entire money system. So they created the Fed, me. Now here's where most people's understanding gets fuzzy, because the Fed is not exactly a government agency, but it's also not exactly a private bank. It's this strange hybrid creature that doesn't fit neatly into any box. It has a board of governors appointed by the president and confirmed by the Senate. That part sounds governmental. But it also has 12 regional reserve banks in cities like New York, Chicago, San Francisco, Dallas, and those regional banks are technically owned by the private commercial banks in their districts. So the Fed is simultaneously public and private, accountable to Congress in theory, but independent in practice, and that independence is the key to everything. The official argument for Fed independence goes like this. Politicians think short-term. They want to be re-elected. That means they're tempted to juice the economy before elections. Lower rates, print money, keep unemployment low even if it causes inflation later. Central banks need to be insulated from that political pressure so they can make hard, unpopular decisions for long-term economic health. That sounds reasonable. It might even be right. But the consequence of that independence is this. The most powerful economic institution in the world is not controlled by the people it affects. Hey! And the 12 people who sit at the heart of its most consequential decisions? You didn't choose them. You can't remove them, and most of you couldn't name a single one of them. Let's change that. The Federal Open Market Committee, the FOMC, is the specific body inside the Fed that sets monetary policy. This is the committee that votes on interest rates, May. This is the room where the decisions get made. Let's break down who they are. First, you have 7 members of the Board of Governors. These are people nominated by the President of the United States and confirmed by the Senate. They serve 14-year terms. Not 4 years like a president, not 6 years like a senator. 14 years. The idea is to keep them above the political fray, insulated from election cycles, free to think in decades rather than news cycles. The chair of the Fed, the most powerful of these 7, serves a 4-year renewable term as chair, even though their governor term is 14 years. Jerome Powell, the most recent. Chair you've probably heard of was first appointed by Donald Trump and then reappointed by Joe Biden. That bipartisan reappointment tells you something important. This role is supposed to transcend political party, at least in theory. Then you have 5 presidents of the regional Federal Reserve banks. There are 12 regional banks in total, but only 5 of them vote at any given time. The Federal Reserve Bank of New York always gets a vote. Always, without exception, because New York is the financial center of America, and the New York Fed operates the actual trading desk that executes whatever the committee decides. The other 4 rotating spots cycle through the remaining 11 regional banks on a rotating annual basis. Now, and this is where it gets genuinely interesting, how do the regional bank presidents get their jobs? They are not appointed by the president. They are not confirmed by the Senate. They are selected by the boards of directors of their regional Federal Reserve banks. And those boards? They include representatives from the banking industry in that region. In other words, the banks that are regulated by the Fed have a hand in selecting some of the people who set the policy that affects them. If that sounds like a conflict of interest to you, you're not the first person to notice. But let's not get ahead of ourselves. The point right now is this: 12 people vote. Some are presidential appointees. Some are selected through a process that includes the banking industry. All of them are highly educated, deeply credentialed economists and finance professionals. And all of them wield enormous power. What kind of power? Let's get into that. The FOMC meets 8 times a year, roughly every 6 weeks. Sometimes they hold emergency meetings, but the regular schedule is 8 times a year. Each meeting lasts 2 days. On the second day, they vote. And what they're voting on at its core is one number: the federal funds rate, PAYK. This is the interest rate at which banks lend money to each other overnight. When a bank ends the day with more reserves than it legally needs, and another bank ends the day short, they lend between each other, just for the night, at this rate. On the surface, that sounds incredibly technical and irrelevant to your life. Banks lending to each other overnight, who cares? Here's why you should care. That one number is the foundation upon which almost every other interest rate in the economy is built. Think of it like gravity. You can't see gravity. You don't think about it every time you take a step. But if gravity changed, if it doubled or disappeared, every single thing about your physical life would change immediately. Pay. The federal funds rate is the gravity of the financial system. When the FOMC raises that rate, it becomes more expensive for banks to borrow. So banks charge more when they lend to you. Mortgage rates go up. Car loan rates go up. Credit card rates go up. Business loan rates go up. The cost of borrowing money across the entire economy increases. When borrowing becomes more expensive, people and businesses borrow less. They spend less. They invest less. They hire less. Economic activity slows down. When the FOMC cuts that rate, the reverse happens. Borrowing becomes cheaper. People take out mortgages. Businesses take out loans to expand. Investors take on more risk. Economic activity heats up. This is the basic mechanism. The dial they're turning. But here's the thing they're actually trying to manage. The reason they turn the dial at all, and this is where the job losses come in, the Fed has what's called a dual mandate. 2 official goals given to them by Congress. Goal 1, stable prices. Keep inflation low and predictable. Around 2% per year is the target. Goal 2, maximum employment. Keep as many people working as possible. On paper, these 2 goals sound compatible. Stable prices and lots of jobs. Who could argue with that? In practice, they are often in direct tension with each other. And understanding that tension is the key to understanding why the FOMC's decisions cost people their livelihoods. Here's the uncomfortable truth that nobody in a suit on television says plainly. Sometimes, not always, but sometimes, the Federal Reserve raises interest rates specifically to increase unemployment, not as a side effect they hope to avoid, as a deliberate mechanism they're counting on. Let me explain why, when inflation gets too high, when prices are rising too fast, the standard economic diagnosis is that there's too much money chasing too few goods. Demand in the economy is running hotter than supply can keep up with. People and businesses are spending freely, bidding up prices, and the whole system is overheating. The cure, in conventional monetary theory, is to cool down that demand. Make money more expensive to borrow, slow spending, slow investment. Slow the economy down until supply and demand come back into balance and prices stabilize. But here's what slowing the economy down actually means in human terms. When businesses can't borrow cheaply, they don't expand. When they don't expand, they don't hire. When existing businesses face higher costs and lower consumer spending, they start cutting. They lay people off. The unemployment rate rises. And here's the part that sounds almost cruel when you say it out loud. In the economic models used by the Fed, higher unemployment is part of how inflation gets controlled. Unemployed people spend less. People afraid of losing their jobs spend less. Less spending means less demand. Less demand means less upward pressure on prices. There is even a concept, a real, named, academic concept called the non-accelerating inflation rate of unemployment, NIRU. The idea that there is a specific unemployment rate, somewhere between 4 and 5%, is typically cited, below which inflation starts to rise uncontrollably, meaning the models literally build in an assumption that some percentage of the workforce must be unemployed for the system to stay stable. Let that sink in. There is a target unemployment rate, and when unemployment falls too far below it, the response from the people in that room is to make conditions tighter until more people lose their jobs. Now, to be fair, economists debate NIRU constantly. Many think it's an outdated and unreliable concept. The Fed itself has moved away from using a specific NIRU target. But the underlying logic that cooling the labor market is part of fighting inflation remains very much alive. We saw it play out in real time between 2022 and 2023. Inflation surged after the COVID pandemic. Supply chains were broken. Trillions of dollars in stimulus had been pumped into the economy, and prices started climbing at rates not seen since the 1980s. The FOMC responded with the most aggressive rate hiking cycle in 40 years. They raised the federal funds rate from near zero to over 5% in roughly 18 months. And one of the things multiple Fed officials said publicly, including Fed Chair Jerome Powell himself, was that the labor market needed to cool, that wage growth was too strong, that getting inflation under control would likely require a period of below-trend growth and some softening of labor market conditions. That's the phrase: clean, clinical, academic. What it means is, some of you are going to lose your jobs, and that is part of the plan. 12 people in a room voted for that. Now here is perhaps the most important thing this video will tell you. The pain from these decisions does not fall equally. When the FOMC tightens monetary policy, when they raise rates and deliberately slow the economy, the people who feel it first and hardest are not the wealthy. They're not the asset owners. They're not the people in that room, or the people who select the people in that room. The pain lands on the most economically vulnerable people first, every single time. Here's how that works. Think about who loses their job first. When a company starts cutting. It's not the senior executive with the golden parachute clause in their contract. It's not the specialized knowledge worker who would cost a fortune to replace. It's the newest hire, the part-time worker, the contract employee, the person in the role that the company considers most expendable. The people with the least negotiating power, the least savings buffer, the thinnest financial cushion to absorb a period without income. Now, think about who is most damaged by a period of unemployment. If you own assets, stocks, real estate, a business, your wealth can actually increase during a rate hiking cycle in certain ways. If you have substantial savings in high-yield accounts, rising rates mean you earn more interest. If you have the financial security to simply wait out an economic slowdown, you might not feel it much at all. But if you're living paycheck to paycheck, which, according to multiple surveys, describes a majority of American workers, a single month without a paycheck is a crisis. A missed rent payment, medical debt that can't be serviced, children going without, choices that no person should have to make. There's also a geographic dimension to this pain. When rates rise and manufacturing investment slows, or when construction freezes because mortgage rates spike and new home building collapses, the communities that depend on those industries absorb the shock. Smaller cities, rural areas, places that are already economically fragile and have fewer alternative employment options. The people in the FOMC meeting room are not from those communities. They are, almost without exception, highly educated, financially comfortable professionals. They have PhDs. They've spent careers at elite universities, prestigious think tanks, major financial institutions. Their personal financial situations insulate them from the very consequences of their decisions. That doesn't make them evil. Most of them are genuinely trying to act in the broad public interest as they understand it. But it does mean they are making decisions about pain they will never personally experience. And that gap between the people who decide and the people who absorb the consequences is one of the deepest structural tensions in the modern economic system. Let's add another layer of complexity, because the truth is these 12 people are not operating with perfect information. Not even close. Economic data is messy. It's delayed. It's revised. It's subject to measurement error and methodological debate. When the FOMC sits down to make a decision, they are working with data that is weeks or months old. The unemployment report they're looking at describes what happened last month. The inflation figures they're examining reflect price changes that were measured and compiled over the past 30 days. By the time the data reaches the table, the underlying reality has already moved. There's a term for this in economics: the long and variable lags of monetary policy. When the Fed raises rates today, the full effect of that decision won't be felt in the economy for 12 to 18 months. Sometimes longer. They're essentially steering a supertanker with a delayed rudder using a map that's already out of date. This is why monetary policy is often described as more art than science. The 12 people in that room are not running a precise mathematical calculation and reading off the correct answer. They're making judgment calls under uncertainty, guided by models that have significant limitations, influenced by their own economic philosophies, their prior career experiences, and yes, inevitably, their own human biases. The Fed speaks in a very specific language designed to manage this uncertainty. They never say, "We will raise rates." They say things like, "The committee judges that an increase in the target range is appropriate at this time." They use phrases like data dependent. They talk about uncertainty around the outlook. Every word is calibrated. Why? Because the words themselves move markets. This is the part that's almost surreal when you think about it. The Fed's most powerful tool might not even be the interest rate. It might be communication. The simple act of suggesting that rates might rise can cause financial conditions to tighten before any actual decision is made because investors and banks start pricing in the expected change immediately. So the 12 people are not just setting interest rates. They are managing expectations. They are shaping psychology, pay. They are trying to influence how millions of businesses and consumers think about the future. Because how people think about the future determines how they act today, which shapes what the future actually becomes. It's a confidence game, in the most literal sense of that phrase, and it mostly works. But when it doesn't, when the Fed misjudges, moves too slowly or too fast, reads the data wrong, or gets caught off guard by an event nobody predicted, the consequences can be catastrophic. The 2008 financial crisis didn't come out of nowhere. The Fed kept rates low for an extended period in the early 2000s, which contributed to the housing bubble that eventually burst. The 2022 inflation surge, which led to the aggressive rate hikes we mentioned earlier, was preceded by the Fed holding rates near zero for longer than many critics thought wise, initially calling the inflation spike transitory, meaning temporary, before being forced to admit it wasn't 12 people getting it wrong, and millions of ordinary workers paying price. So now the obvious question: who holds these people accountable? The technical answer is Congress. The Federal Reserve was created by Congress. Congress could, theoretically, restructure it, change its mandate, or abolish it entirely. The Fed chair testifies before Congress twice a year in a process called the Humphrey-Hawkins testimony. Senators and representatives get to ask questions. They can criticize. They can grandstand. They can demand answers. But here's what they cannot do. They cannot override a specific FOMC decision. They cannot say, "We're voting to keep rates where they are," and have that count for anything. The committee's operational independence is protected. Congress can change the rules of the game, pay, but it cannot make the moves. The president nominates the board of governors, including the chair. That gives the executive branch some influence over the institution's composition over time. But a sitting president cannot fire the Fed chair for making decisions they disagree with. Or at least it has never been done, and whether it is legally possible is genuinely disputed. Markets, in a strange way, provide another form of accountability. If the FOMC makes decisions that investors believe are deeply wrong, financial markets react, sometimes violently. A market crash following a Fed decision is a form of immediate feedback that the committee takes very seriously. In this sense, the wealthiest and most financially sophisticated actors in the economy have a mechanism to signal disapproval that ordinary workers simply do not have. This creates a troubling dynamic that critics point to repeatedly. The Fed is technically insulated from electoral politics, but it is highly sensitive to financial market reactions. Or, the people with the most stocks have the most voice, even within a supposedly independent institution. There's a term some economists use, the Greenspan put and later the Fed put, referring to the widespread market belief that the Fed will cut rates and intervene to support markets if they fall sharply enough. Whether or not this is formally true, the perception shapes behavior. Investors take on more risk because they believe there's a backstop. And who benefits most from rising asset prices? People, who own the most assets. Meanwhile, ordinary workers have no equivalent put. There is no mechanism that says, if unemployment rises above this level, the Fed must intervene to protect workers regardless of inflation. The dual mandate requires considering employment, but how that consideration is balanced against price stability is entirely at the committee's discretion. This is the question that divides economists and political thinkers. Is there a better system? Should monetary policy be democratized in some way? Should interest rates be set by elected officials? Should there be more transparency, more diversity, more representation from working people in the process? The defenders of the current system make a serious argument. They point to countries where monetary policy has been politicized, where governments printed money to win elections or fund wars, and the result was hyperinflation that devastated the very working people that political control was supposed to protect. Zimbabwe, Weimar Germany, Venezuela, Argentina. When politicians get direct control of the money supply, the temptations to abuse it is often overwhelming, and the consequences are catastrophic. The independence of the central bank, in this view, is not a design flaw. It's the feature. It's what keeps the system from being hijacked by short-term political incentives. But critics respond that this framing sets up a false choice. The alternative to the current system isn't necessarily hyperinflationary chaos. It could be greater transparency in how decisions are made. It could be more genuine diversity in who sits on the committee. Not just racial and gender diversity, though that matters, but diversity of economic background and professional experience. What if there were seats for labor economists, consumer advocates, or people who have actually lived through job loss and financial hardship? Would the committee's decisions look different? Some critics argue for a different mandate altogether, that the Fed should be legally required to weight employment more heavily relative to inflation mood, that the 2% inflation target is itself a political choice, not a mathematical inevitability, and it could be set differently. Others argue for more radical structural reform, that the regional Federal Reserve Bank system, with its ties to the private banking industry, creates structural conflicts of interest that undermine the institution's ability to act in the public interest. These are real debates, happening in real academic journals and congressional hearing rooms. They don't have easy answers. But the fact that they're happening at all suggests that the current arrangement isn't simply the only possible way to run a monetary system. It's a design choice, and like all design choices, it reflects the values and power structures of the people who designed it. You might be thinking, okay, this is interesting history and theory, but what does it mean for me today? Here's the direct answer. The decisions made in that room determine the job market you're entering or navigating right now. They determine whether your mortgage rate is affordable or punishing. They determine whether the business you're thinking about starting can access the capital it needs. They determine whether your employer is expanding or contracting pay. Understanding this doesn't mean you're powerless. It means you're informed. And being informed changes how you make decisions. If you know the FOMC has signaled that rates will stay high for longer, you know that the job market is likely to stay tight, that housing will remain expensive, that borrowing will remain costly. You can plan around that reality rather than being blindsided by it. If you understand that the Fed's decisions have distributional consequences, that they don't affect everyone equally, you start asking better questions about economic policy debates. When someone tells you the Fed needs to raise rates to fight inflation, you can ask, raise rates for whom? Cool the economy for whom? Who absorbs the unemployment that this policy is designed to create? These are political questions disguised as technical ones. And one of the ways power sustains itself is by convincing ordinary people that the technical questions are too complex for them to engage with, that the experts have it handled, that you should just trust the process. The process is real, the expertise is real. But so is the power, and so is the accountability gap. Let's bring this back to where we started, 12 people. 1 vote. Hundreds of millions of lives affected. Now you know who they are. Now you know how they got there. Now, you know what they're actually doing when they raise or cut rates, and who pays the price when they get it wrong, or even when they get it right. The Federal Open Market Committee is not a conspiracy. It's not a secret society. It's a real institution operating in plain sight, doing its best, by its own lights, to manage an impossibly complex system. But doing its best and being above scrutiny are two very different things. Every time the FOMC meets, they are making value judgments. Who should bear the burden of inflation? Who should bear the burden of unemployment? How much economic pain is acceptable, and for whom? These are not purely technical questions with mathematically correct answers. They are choices. They are political choices, and they are being made by 12 people who were never voted into the room. The least we can do, the very least, is understand what's happening in that room. Speak. Because the first step to changing a system is knowing how it actually works. Now you know. If this video gave you a new way of seeing the economy, share it with someone who needs it. Because this is exactly the kind of thing they don't teach in school, and probably never will. See you in the next one.